big hello and a very warm welcome to Brand Equity with me, Sonali Krishna. Over the next 30 minutes, we're going to be deep diving and taking a look at the startup ecosystem and look at how funding has been impacted during the pandemic, which is why the topic of today's discussion is rightly called, Where's the Deal? And who better than the most active VCs in the COVID era to give us a perspective on what's hot and what's not. So without further ado, let me introduce to you my esteemed panel. Vikram Gupta, founder and managing partner, IvyCap Ventures; Kartik Prabhakar, executive director and partner at Chiratae Ventures; and Choudhary, managing director, Beenext. Thank you so much, gentlemen. Truly a pleasure having you on Brand Equity. My first question will be, broadly going to ask all three of you to give me a perspective on deals and funding in the startup ecosystem that have taken place, let's say, take our base year as 2019 and juxtapose that with the kind of performance we've seen in the startup ecosystem in terms of share funding versus 2020 and versus 2021. Let me begin with you, Vikram, in terms of your perspective on deals 2020, 2021, juxtapose it with 2019's performance.
Yeah, I think last 18 to 20 months have been quite interesting, and we've all seen substantial changes in the consumer behavior and the way people are working, how they're buying things. And there's been a substantial reaction to this entire COVID situation. We've also seen in the broader picture how digitization has accelerated in the last 18 months. In fact, the internet penetration has accelerated quite substantially. Even in the tier 2, tier 3 towns, rural India, there's been a substantial penetration of mobile phones or smartphones and internet, which has actually accelerated the growth of e-commerce, online buying, fintech, health tech, even edutech, as we've seen now across different other sectors as well. This has actually increased deal activity across different stages, right? So we've seen Series A deals increasing quite substantially. We've seen a lot of follow-on capital coming at Series B, Series C. And of course, we've seen quite a few exits as well. Right? In fact, we at IvyCap made 3 exits in the month of March this year when we sold 3 companies, returning about 510 crores back to our investors. This was just before the second wave started. And all this is actually being driven by what's happening in the US, what's happening in China. There is a little bit of backlash happening there in China, and then the capital which has got generated in the US with all these SPACs that happened last year. Just in last 1 year, we had $110 billion of capital raised through these SPACs, and all that is getting directed towards developing economies like India. So of course, Indian startups are beneficiaries of that. So just in this year, we've already seen about 21 new unicorns, more than 50% of the unicorns created until end of last year. So all these are very interesting signs of the growth happening in the economy. Of course, there are questions around, is this short term? Is there a bubble? How long is it going to last? I think our view is that this is here to stay at least for a period of time, especially when you're looking at startup ecosystem at Series A, Series B levels, and even beyond. The activity will continue to be there. We'll see many more IPOs happening in the next couple of years, and many more unicorns coming up in the next 3 to 4 years.
Okay, so that's a very optimistic outlook coming in from Vikram. Let me see if I can get a contra view. Kartik, 2019 versus 2020, 2021, your perspective on if the deals have shrunk or if the deals have grown, and more importantly, my adjoinder question to you is, have there been substantial changes at how VCs are looking at funding? So did 2020 change the way all of you look at startups and size up startups?
Let me first start by saying I think it's hard to take a contra view in such a positive environment. But let me just share my quick perspective and use some numbers as well. Clearly, as Vikram also highlighted, 2019 to 2020, yes, there was indeed a dip to some extent. At least if you see immediately the time post-COVID, I would say if you had asked me this question in August of 2020, it would have been a very different answer. we were all staring, we were all actually inward focused, focusing on our portfolio companies. Nobody knew where the end lie in sight. And one may argue even now nobody knows, but still at that point in time, there were a lot of companies which were actually going through turmoil, letting go of people, and shrinking their costs, and so on and so forth. But I think the good news is somewhere around November, December 2020, things started changing to the positive. In terms of investments, in terms of underlying companies, many of the companies actually got adapted to the new world. If I take our own portfolio as an example for that, between March and August last year, we had almost all companies going less than the pre-COVID numbers in terms of their traction and so on. But by December or so, almost 80% of the portfolio had come back to pre-COVID levels. So that was one simmer of hope. Of course, the second wave was a lot more devastating to a large extent. But I think entrepreneurs by then had become a lot more resilient. And that's the only explanation I can give on why things did not take a similar turn in 2021. But rather, entrepreneurs were prepared for this. They were more resilient, which also is reflective of the deal activity. That's one part of the story. If you take another part of the story, the COVID actually catalyzed the digital adoption, and digital adoption became a necessity. Yes, there was internet penetration growing, smartphone penetration was growing, and it accelerated to some bit post-COVID. But I think the adoption of what people already had in their hands increased multifold. People already had smartphones, people already had some internet connectivity, but their utilization pre-COVID was largely a good to have. It's nice vanity value for a large part of the population. But post-COVID, it became a necessity. You have kids, you have to have some connectivity. You are sitting at home, you need connectivity to order in stuff. So I think it became a huge necessity. That also is reflective of the investment activity. What the COVID has catalyzed is the consumer adoption has just skyrocketed. Now, if you see numbers as industry, and I'm just seeing the IVCA data itself, in 2019, there was roughly around $13 billion that got invested in the VC ecosystem, be it early stage, late stage put together. Whereas 2020 and 2021, the last 1.5 years put together, it's been $28 billion. So that's a huge jump. And if I see our own Chiratae data, I was just looking that up. In 2019, we had deployed around $99 million across new investments, follow-ons. And if I see between 2020 and 2021, March 2022 till date, it's again $100 million. So despite around a quarter or so of inactivity, where we were all focused on our portfolio companies, despite that, I think there's been a tremendous growth in terms of deployment. And similarly on the exits as well, I think the market has just catalyzed, and we'll see more of those to come. And we had our own share of some exits, and I'm sure industry has had a lot more, and we'll see more of those. So I think the general positivity has increased. Just to add to that in terms of, just to take that, slightly different perspective as well. Going by what we have seen in some of the past cycles of hyperactivity is generally followed by some sort of lull. And that doesn't necessarily mean that the market is going down. In fact, it's a very relative thing, because you see so much of activity. A little bit of coming back to normal is also seen as a lull. But in the past, we have seen that things have gone back to some sort of a slowing down, tempering down. And at those times, I think businesses which are fundamentally built on strong fundamental first principles, unit economics, continue to thrive. Or businesses which are creating new markets and which are well capitalized, continue to grow. I think one of the two is extremely important. being in the middle is not going to help and is not going to be an answer. And the unfortunate truth is that nobody knows when that transition happens. It will only be seen in hindsight.
Thank you for that perspective. And, you talked about the IVCA data, and which is what the question I'm going to pose to you, Hero. So we have the IVCA investment data from 2016 until 2021, and I think the reading is quite interesting. So while in terms of, just value, if you compare it to 2020 and 2019, there has been significant growth because, 2019 we stood at, $13 billion, and it's kind of tapered down in 2020, and we're standing at about 17.2 in 2021. Significant growth, highest. I mean, there's a meteoric rise from 2016. However, if you look at the number of deals, the deals have shrunk, and 2021, of course, we've only finished, first half of the year. So I'm assuming it will go up sizably. But would there be any merit in stating that values of deals have gone up and not actually number of deals, and we're seeing that as a new trend, that there are more big ticket deals happening?
I think that's a pretty interesting question, actually. And if I just use historical anecdote in the world of technology, if you look at just 20 years of data, what happened in US market, what happened in China market, basically tech is a big, massive network effect, data effect business. Basically, big gets bigger. It's as simple as that. So when you apply that theory over time to India's ecosystem, also companies that got started anywhere between 2013, 2014 till 2017, 18, they are growing, they are getting bigger, they are maturing. And as big gets bigger, those companies just suck in a lot more capital because their business model has been de-risked. They are becoming very big force in the ecosystem, and they can deploy massive amount of capital at scale. Use that analogy and then use the material liquidity that is in the system because of easy Fed policy, because of all the other things happening. A lot of IPOs coming out now from India and Southeast Asia, which means more liquidity will get created, and that liquidity has to go somewhere. And easiest way to do it is to put it in the companies that are scaling very well and growing faster. So that's one way to look at the data. There are many ways to skin the cat, and you can basically look at what's happening at a stage level. Are Series A or lower stage, are those deals becoming less and less? Answer is probably no, just the check sizes are smaller, but bigger check sizes are happening in C, D, E stage deals that were not there a few years ago because ecosystem was not that dense enough. So as ecosystem gets bigger, as the density builds out, bigger guys, bigger companies just take in a lot more capital. So it's pretty natural in my view to have that evolution, and India market is no different.
Hero, would you say that today we noticed that the entire startup ecosystem is geared onto the valuation game and not so much onto the fundamentals game? This is an observation that, there is a big dichotomy between the valuation versus the actual P&L. And is it also fair to say that in this COVID period, especially for sectors that have been superstars, right? Like there have been few superstars, the valuation is, has been layered to such an extent where it seems not feasible. I'm sorry, I'm playing devil's advocate. I'm not
okay.
Sharing the same optimism as the panelists.
No, it's okay. I think it's a right question to ask. When you see everything going from lower left to upper right, you have to make sure that it's the right thing that is happening in the market. And if everybody sees that valuation is going up to the right only all the time, you can always imagine that there will be entrepreneurs who will be coming in who see that there is a lot of capital available. Can I quickly capitalize on it, right? And in shorter term that can play out, but longer term, I think valuation and fundamental catch up with each other. So I think a very simple way to look at it is, or very simple way to think about it is, like not all revenue is created equal. In the same way, not all unicorns are created equal. Over longer term, some will hold true to the fundamentals, some won't, as companies grow and mature, because once these companies grow and at some point they have to come public, they give exit to investors. A longer term, investors will have to see that they have to have sustainable fundamentals, cannot be loss-making business forever.
Vikram, we've seen some sectors, such as streaming and short video, ed tech, video conferencing, gaming, e-commerce, online direct-to-consumer, hyper-local services, fintechs. All of them have seen, COVID has played advantages to them. I mean, we've seen them really blossom and bloom. However, give me a perspective of the other side, the dark side, the have-nots, travel, tourism, hospitality, shared mobility, stuff that is, where it is also showing promise, but unfortunately, because of the pandemic, have been, left on the roadside. What is happening in that space? How are VCs looking at them? If you've invested in companies, let's say pre-pandemic, how are you, re-looking at those deals?
There has been, quite a few changes, or there have been quite a few changes in the way some of these sectors, like as you mentioned, travel, hospitality, even retail or offline retail, right? So you've seen substantial change happening there. Restaurants, for example, have converted into cloud kitchens, right? So, this pandemic has actually given opportunity to quite a few companies to actually transition to new business models. People have started working from home. Nobody ever thought that we will be sitting at home and consuming bandwidth, and everybody in the house will actually be needing internet, and everybody will be sitting in separate rooms or will need space. So the entire real estate sector, for example, has started going through the transition in terms of designing homes in such a way that people can work from home, right? So there is emergence of new business models across sectors. Healthcare, nobody ever thought that they would, even for the first advice, they will actually be sitting on online, taking advice from a doctor. Even doctors are not comfortable using, internet to give advice. We've seen that substantial change happening. The kids, for the last 18 months are sitting online, taking online classes. Even though people are quite fed up and bored of all this now, they really want to go out. And, I've seen that if you go out, in some of the holiday destinations, you hardly get space these days. The hotels are all booked because people want to go out. But I think there has been a fundamental shift in the way people consume things, right? So across all the sectors, whether it's fintech, health tech, edutech, of course, e-commerce has seen a huge boost because of even older population who never thought that they would actually, buy things online. So all these things have actually contributed to a fundamental shift. I'll give just one example. Jewelry, overall sector has actually shrunk. People have stopped, or not stopped buying, but at least reduced buying. All the marriages, etc. You see that there is only a defined number of people who can actually go for these marriages. So the consumption that used to happen for these marriages, jewelry, clothing, etc., that has gone down substantially. So the industry has overall shrunk. But because of the shift from offline to online, businesses like Bluestone, which has been an online jewelry business, has substantially gained because of that. So there's been a substantial growth in such businesses. So that's the kind of trend we are seeing, in terms of offline to online shift, people changing from offline retail to online retail. And that's very positive from venture capital perspective to invest in these newer age businesses.
Kartik, let me ask you a question from a completely different perspective. As a layperson, right, an observer of human behavior, humans are creatures of habit and we're social animals. And while we have seen trends such as we're doing this conference, I'm talking to all of you, via Zoom, and there we are working and talking to colleagues via Zoom, and it's been a year and a half, and we're not really going back to physical contact. But we've also seen that every time there is some relaxation in the lockdown, let's say, in cases of Bombay, Delhi, Pune, some of the metros, you see people going back to their natural habits, right? You see people going back, bars are full again, restaurants are full again until the next lockdown comes in, and that's the lockdown and on, lockdown, down. So this is we're just leading our lives. But at no point do you see when a lockdown is relaxed, people are still not going out of home. Everything is busy, almost as if the pandemic is over. So that's obviously our natural habit. Similarly, if you look at online, if you look at EdTech, for example, everybody is online doing online education. All the children are bored. We are bored looking at boxes on the screen. Do you think we're reading too much into the habits that have been created because of the pandemic, assuming that this will have a long-lasting impact? And have we forgotten that what we've been used to for so many years since birth, we're giving it less importance and thinking that that businesses that have kind of lost our example, cinema, over and out for now. But who knows in the cinema? I mean, I'm not sure if I want to sit at home and watch a fantastic movie on my TV set and cast it and not go to a cinema. I'm not sure. I'm saying, so do you think similarly, if I extrapolate and say the kind of investment VCs are making are betting mostly on the current trend we are seeing because of our consumer behavior shift because of the pandemic?
Sure. So I think time will tell on the larger answer for that. But let me take a few examples that that can help substantiate. If you take cinema as the example, as you said, I think the consumer as a market, my belief is that in the long term or even in the medium term, I think this habit of consuming at your place, at your will, is going to become a habit. It's sheer convenience and it's sheer comfort for a large base of the population, where the joy of going and watching in a group, you possibly enjoy it a lot more in your own group. So possibly my view is it's going to be more and more access to the content where you possibly have a space which you could rent out and you could have a gathering of your own. That's the farthest I can think as cinema. A cinema theater which is 100 seats getting occupied by a lot of people who you don't know. I personally feel it's going to be a challenge. If you see the multiplex also, I think the trend is very seen. Even pre-pandemic, the earlier theaters were 400 seats. They've gradually come down to 70 seats, 100 seats. That's for a reason. And I think, in my view, pandemic is going to accelerate that. And there will be a lot of micro, possibly just like co-working space. I'm just thinking about it. No investments have happened in that space. But micro spaces of entertainment is what one would possibly look at. Now, if you take a very different example like EdTech, for kids, there are two parts of learning for them. One is the tool sets that they learn in their younger days. The second part is the social learning. And the social learning definitely does happen through the physical connect and the physical touch points, and that's where the social behavior gets built. If you see, by and large, the EdTech investments, they've largely been around the co-curricular activities and augmenting the education. Just taking everything online and your entire learning to be sitting at your place, I personally feel it's a far-fetch. You need that other part of the learning as well, which is social, which is where, if you see, most of the companies or most of the investments that are happening are more augmenting that learning rather than saying this is a replacement to your physical learning. Anything which replaces the physical learning completely, I feel in the medium to long term will be a challenge. It has to be a combination, which is so true even in our workspaces. We are doing these Zoom meetings. Clearly, all of us see that there is efficiency, but nothing like actually meeting in person. So the habit does get extended to some point where you may not meet for every single thing in a face-to-face setting, but you'll possibly make it a lot more efficient as you go forward. You wouldn't, go to the airport, fly down for every single meeting, but possibly we'd all hopefully bring efficiencies where you're clubbing them and making it a lot more efficient. That's where I see the habit forming going in the medium term. Of course, in the short term, there will be some sort of a, as you call it, the revenge travel, which people will do, but I guess that will settle down.
Hero, are you agreeing with Kartik on the fact that yes, some of them are habit changing, for good, or are we just reading too much into these habits? These habits have come by force, not by choice.
I really don't know the answer. Only time will tell. But we think some of those things may be here to stay, but only time will tell.
Fair enough. I think I'm out of time. But thank you very much, Vikram, Kartik, and Hero, for sharing your candid thoughts. More power to VCs like you. More power to entrepreneurs who are, struggling, innovating, and buckling up and treading the tough path. And hopefully, we'll see better times to come. Thank you so much.